Thanks for joining us, everyone, and I'm glad to be here, and this is my presentation on dominating earnings season. It's just around the corner once again. It's something that happens 4 times a year, and there are specific strategies that you can use to take advantage of earnings season, and I wanted to share some of those with you today. So welcome. Let's get started. Before we get into this, a bit about myself and Trading Wins. I'm Vince Vora. I'm the head trader here. I have been trading for 30 years. It's been a crazy ride, but it's been so much fun and amazing. And I'm the head trader here at Trading Wins. Here, these are just some of the trades that we've put out for our members recently, and what you're seeing here are not dollar amounts, they're per share amounts of trades. We've had some nice ones lately. I'm going to share some of these strategies with you. We've been developing our own strategies and trading systems over the years, and they actually work extremely well. They've been very consistent, and they're not only used by retail traders, but also some hedge funds. Now, in today's presentation, what I want to focus on is the right way to trade earnings. I'm going to share 3 strategies with you. Strategy number 1, we're going to talk a bit about implied volatility. This is really where everyone goes wrong with earnings, and so I'm going to show you the correct way to do this, to take advantage of those trades. Number 2, I'm going to show you an option strategy that you can use where you really, you have that 10-to-1 reward to risk potential. Sometimes it's even more. I'll use a specific example today and share that with you. And then one of my favorites is normally after that earnings announcement, there could be an explosive move, and I'm going to show you something that you can take advantage of that move with. A great strategy that I've been using for a little while. Now, hopefully we'll have time for questions as well, and we'll get to as many as we can with the time permitted. Please do remember that trading can be risky if you don't know what you're doing, so please don't trade with real money until you're completely comfortable with the strategies and systems you're using. So let's get right into this and talk about our first strategy, which is how do we use implied volatility to your advantage. Give me 1 second. I'm just going to adjust my mic a little here. There you go. Let me know if you can still hear me well. All right. Let me bring up my charting platform, and let's get right into this. So, you know, one of the biggest mistakes that I see traders make over the years when they're playing earnings is with trying, number 1, to guess a direction, one way or the other. And so, for example, here we have Lululemon. And you see that down here, they have earnings coming up on March 30th. And actually, for those of you who are using TOS, and may not, TOS, by TOS I mean Thinkorswim, and may not have these up here, what you can do is just next to the time frames up here on the right, go to chart settings, and on the general tab here, you can select to show, where is it now? Corporate studies, one of these areas. Maybe it's on the time axis here. Yeah, here it is. On the time axis, auto expand to fit corporate actions. Make sure you have that ticked off. That will give you these little red icons here at the bottom, where if you hover over, it'll give you the actual next earnings date. So you'll have these show up on your chart well in advance, and you'll know when to expect that. The other thing you can do is actually, there's a website here that I'll share with you that's quite good for earnings announcements. I'm not affiliated with them in any way. I just like using it. I thought I'd share that with you. It's earningswhispers.com. And if you go here, they have a nice calendar tab where you can see all the upcoming earnings events, and you can select the date you want anytime in advance and see all the companies that are due to release earnings on that date. So those are a couple of easy ways to know the exact date coming up. But getting back to the mistake that most people make is the day before or the day of the earnings release, most people will try to either guess a direction of the move after earnings, or they'll do both. They'll buy a straddle, they'll buy a call and a put hoping to take advantage of a big gap one way or the other, because usually stocks gap after their earnings announcements. Well, the problem is this. It's implied volatility. Now on Thinkorswim, if you go to the trade tab here and you collapse all the option chains and you look to your far right, these percentages here, this is the current implied volatility. So what you'll notice when you do this, for each underlying security, there'll be pretty much an average. And for Lulu, it's, you know, low to mid 40s is really the usual average implied volatility. And that's a good gauge to use. Now what you'll notice is that as we head into the earnings season or the earnings date, release date, this implied volatility percentage will spike. And right now, the implied volatility for Lulu is at 76% for the option expiration date that happens right after that earnings release. So in other words, March 30th, I believe, is next Wednesday. This is the Friday. So there's 8 days currently at expiration, and you can see that we're already at 76%. Now, as we get closer to that release date, this will continue to spike, and it's not uncommon to see this well over 100. Okay? Well, here's the thing. As soon as that earnings announcement is made, and the market opens the next morning, what you'll tend to see is a volatility crush. In other words, this percentage will fall right back in line with the average. So imagine if this was the earnings date and it was at 76%, and then it immediately after earnings dropped back to the low 40s. Well, that's a 30% drop. That means you will immediately lose 30% of the premium in your option automatically. Now imagine if this was at 100 and we did that, we'd lose about 60% of the premium in that option. So if you're buying that straddle, that call or that put, you'll immediately lose 60% on either side. And that's why many traders, even though they may get a gap in their favor, are surprised to find out that they're not actually making any money. In fact, they're losing money on that option, even though it did gap in their favor. That's the real problem. So what you want to do with this is actually look at a chart of a stock about 3 weeks or so before that earnings day. That's why it's important to know when it's coming up. And you want to look at about 3 weeks before, and then look for a proper setup. We have several strategies that we use here at Trading Winds. You may have your own that you really like, but you've got to find a proper setup, one way or another, one direction or another, it really doesn't matter, that it happens about 3 weeks before that earnings date. The reason being is, number one, if it works out in your favor, okay, let's say this was your setup right in here, this engulfing pattern right in here, okay, and it started to move in your favor. Well, not only would your option appreciate because of the gains in the stock, but also because of that implied volatility spike. So as that implied volatility figure goes from the low 40s or mid 40s up towards that 76 and maybe even 100%, that means the premium on those options is inflated. It just becomes more and more inflated. They get more and more expensive. So you benefit from both the appreciation in the underlying stock as well as that spike in implied volatility. Also, if you had gone long here calls, for example, and it started to go against you, okay, your loss would be less than usual, because as the stock may be moving against you, the implied volatility is still spiking because of that earnings event. So you have a bit of a buffer there, which helps you out. So it's a great time to put on a trade. The secret really is to get out of it before earnings, because anything can happen after that earnings release. The company can release great earnings, and you'll still see you could still see a significant drop if their forward guidance was bad, or for whatever reason. So really the trick with earnings is not to try to guess the direction or to try to put on a straddle the day before, the day of. It really, you want to try to get in ahead of time, and when you have a proper setup with a strategy that you're using and it goes your way with that implied volatility spike, it's pretty powerful. So that's really what you want to look at. Now, let's move on here and talk about our next strategy here. Let me bring back my presentation here, and what we want to talk about now is a way to put the odds in our favor. So here's a strategy, an option strategy that can really give you most often a 10-to-1 reward to risk ratio, and more often than not, much more than that. So let's talk about butterfly spreads. How many of you are familiar with butterfly spreads? Let me know, please, by typing a yes or no. If you do know what it is or not, I will quickly explain it anyway, but I just want to make sure everyone has an understanding before I show you this strategy. Okay, we have a few yeses, mostly no's. Okay, so let's go through this quickly. A butterfly spread is a combination of a debit spread and a credit spread, okay, and they overlap. And I'll show you in a second. We're going to actually construct one. But the thing to know, oh great, Lou and Carlos say they're very familiar. That's great. I'm sure you're going to love this one. So the thing to know about earnings is that once you do get that gap, what tends to happen is a follow-through to a level of support or resistance, a significant level of support and resistance, okay, one way or the other. So if, for example, we were here and there was an earnings release about to happen, we would look both to the long side and to the short side and look for a significant area of support or resistance. And then we would target those areas as zones to put on butterfly spreads. And what we're actually going to do is put a butterfly spread on both ends, because it's anyone's guess as to which direction the stock is going to gap. And again, we're not in the game of guessing the direction. We just want to take advantage of a move should it happen. Okay, so first of all, I'll share with you a very unique way of identifying very significant areas of support and resistance. And not many people use this, but it's very effective. If you're trading on a daily time frame, what you want to do is move to your weekly time frame, okay, and then actually switch your graph from a candlestick or a bar graph, whatever it is, to a line graph. And then you want to select these points. See all these peaks? These are all the pivots. And you want to draw your lines to areas where you're going to get two or more, actually three or more would be best, areas where these peaks line up with that line. Now, it doesn't have to be perfect, but certainly, you know, it's more of a zone, but as close to it as possible. So, for example, we draw a line there. You see you have 1, 2, 3, for example, okay, and then you have another significant zone down here where you have a few peaks hitting that zone. And once you do that from top to bottom, and once you're done, you go back to your daily, okay, and you go back to your chart style, be it candles or bars and so on, and you'll see just how well these act as areas of support and resistance. You'll see just when price gets around there, it usually hangs around and then either bounces through, bounces off it, or breaks through. And when it breaks through, it tends to go to the next level and back and forth. So that's one easy trick for you to use to identify those levels. Now, let's talk about putting on a butterfly spread here. And I'm actually going to use Netflix as an example. Do many of you trade Netflix? Netflix is known to gap big time on earnings. So let's have a look at this. Now, earnings is a little ways away. It's April 18th, so we've got plenty of time here, okay? A little too early to put on butterfly spreads now, but this is a great example. If we have a look at where it is now and where it might go towards that earnings event, let's have a look at a significant area of support and resistance. So we have here, it's say around $97, $98 right now. If you go down to the 88 level, which is right in here, oops, let me draw that for you in here, right around here, you'll see there's support there, okay? And to the opposite end, if we look at right around this 108 area, there's some support right here. So let's say we're targeting these two levels. We thought it's going to gap, and it can go to one or the other. Now, one great trick is to look back at all the previous gaps and measure the move. Okay? Typically, stocks tend to gap approximately the same amount. So you want to make sure that these levels are approximately that far apart. And now, what you want to do is put on a butterfly spread up here and one down here. And here's the reason why. If we go to our chain, now you want to select the strike right around that expiration date. Okay, now it's a little early now, but let's pick this and let's go down here. Actually, let me go back here for a second. Let's pick this one. Let's say it was expiring this week. What we want to do is, one of those levels we targeted was the 108 level. You want to go here, right-click, and put on a butterfly spread. Now you're going to see that here's that combination of debit spread and credit spread. So you're long, say the 107, short the 108, and then you're short the 108 and long the 109. So that mid-strike is where you want the stock to settle in around near expiration. Now you can widen these out. I'm going to go out a little further, say to 105, and here to say 111. Okay, and you can see the cost, 8 cents. Okay, 8 cents. So even for 10 contracts, that's going to cost you about 80 cents. All right, and if we analyze this trade, let's have a look at the potential risk reward on here. Now this is certainly a crazy amount, not the typical example, but you often do see this. Here, this little tent you see here, here's the break even down here on one end near 105, and here 111, the extremes, the 105 and the 111 down here. I don't know why that's on there. Let me close it. There you go. So you can see these flat lines down here are your risk. So if it closes anywhere below 105, you're going to lose the full amount, which is about $80. If it closes above 108, you're going to lose the full amount, which is about $80. But anywhere under this tent, you're in profit zone. And if it closes right down the middle, right near 108, you have the potential of making almost 2,500. Now again, this is an extreme. Usually it's about a 10 to 1, but there's still great odds in your favor. And the other thing you want to do when you put it on a butterfly is also look at the put side. So you can put this on at either the call side or the put side, whichever is cheaper. So if we put on a butterfly here, you'll see it's even, well, we have to spread this out again and go to 105 and 111. And now you see it's 15 cents. Okay, so on one side it was 8 cents, the other side is 15 cents. Obviously, we're going to buy this on the call side where it's 8 cents. Okay, and then you want to do the same at that 100 at the other level there. What was it? Going back here, the 88 level. That's right. So you go to the put side and do that 88 level right in here, and you'll see that you'll come up with a very similar risk reward. Here we'll go to 85, and we'll go to 91. And there you go, it's about 15 cents. But again, you want to check it on the call side. So the key is here that once it gaps, okay, if it closes anywhere near there around expiration, you have that potential of multiplying your gains by a factor of 10, if not more. Well, really you're only risking $80 or so on one side and 80 on the other, okay? It's very effective. Now, lastly, let's talk about how to do this. Let's talk about how to do this after the earnings release and what strategy can we employ after that earnings release. This is one of my favorites, actually, because you actually get to wait for confirmation. So I'm going to put on a slightly different layout here. I'm going to add an indicator on here, and it's called the Keltner channels. Okay, the Keltner channels. Let me show you, for those of you using Thinkorswim, just go here and right here. There's the Keltner channels. add it and click OK, and you'll be all set to go. I use the default settings, and here's how simple this strategy is, okay? Let's look at, for example, UTX. Okay? Now, you wait for the earnings to be released and for the stock to open the next day, okay? And you wait for that gap if it happens. Now, the key is that on the day that the day after the earnings release, okay, or if they're released in the morning before market open, that earnings day, you just want to sit back and watch, okay? You're not doing anything. You're waiting for that bar to close. Now, if that bar closes outside either the bottom Keltner bar or the top one, outside, so either well below or well above there, then you're interested in that chart. And the following day, what you're looking for, if it trades below or closes below that Keltner bar, you're waiting for a trade just below the absolute low of that candle, okay, right here. So if you get that, you would go short, and you can do so by shorting the stock or by buying a put debit spread or selling a call credit spread, whatever you're comfortable with. And you're going to remain in that trade until you get a close, not a trade, but a close above that bottom Keltner bar, so right in here, okay? So this one would have taken you from around the 101.5 area down to about 98.5, okay? That's simple. So, and here, this earnings date, you'll see that it gapped above, okay, closed above the high, and you're in it until you get a close below that low of the top bar. Now, some will be small winners, some will be break-evens, even small losses. What you're in this for is those ones that really take off, because this is a momentum type play, okay? This is a momentum type play, and sometimes you'll get stocks that really make a move afterwards, such as this one here. Here's Disney. Here's a classic example. And I love the ones that go from one extreme, one side of the Keltners to the others, okay? So you get that gap on earnings. We let it close. We wait for a trade below the low of that bar. We get in, and we're in it up until we get a close. Not a trade, but a close above that low Keltner bar, okay? Let's go through a number of examples. And you can look at this. I'll ask you to do that on your own time. Go through many charts with earnings, and you'll notice once they gap, and it's always better if they go from one side to the other, but regardless, what you want to make sure of is that they're closing either above the upper Keltner channel or below the lower Keltner channel. If it ends up after earnings within the Keltners, you don't want to trade it, okay? Or if it gaps up here, for example, on this bar, but doesn't trade above that high, hovers around for a few days or trades below, you're not really interested in that. You want it to trade above that high on the very next day. Hey, maximum 2 days, not more than that, because this is a momentum play. If it hangs around there for a while, obviously the momentum isn't as strong as we had hoped, okay? So, but whenever you get a close outside one of these bars, like look at this one here on PG, right? Was inside, close outside, boom. Wait for a trade below the low, it starts moving. It's all momentum. It's all momentum based. And this one took us all the way down to this area here. Okay? Even if you had waited till this bar, you would have did fine. But any close, actually, sorry, it was this bar right here. This was the first close above that line, right in here, this level. Okay? And those moves can be substantial. So when you get a move such as this here, where it closes below, okay, triggers, it might get you in and out very quickly. That's totally fine. I'm more than happy to risk a break even a small loss, because when it does go my way, the win is substantial. And I'll show you a few more here. And by the way, let me know if any of you have any questions on these at all. And I'll clarify for you. But here's Walmart. Here's another example. We went from inside and really near the top end of that Keltner bar. It gaps, closes outside or below that Keltner line the day after the earnings release. The very next day, we get a trade below that low, and off it goes till here, right in this area, where it closes back above that Keltner line. Okay? Here's another example. And I encourage you, when you're looking for the strategy, to look back and see how this strategy would have worked on this particular stock, because there's a few like Walmart where it works very often and very well. Okay? Here's another one. Okay? And remember one thing too, you don't need to sit through this whole trade. If you've got a substantial runner, you've got a really nice profit in, you can start scaling out and moving this, you know, your stop down and trailing this. You don't need to wait until you get that close back above if you've got a really strong winner. Obviously, there's always a chance of another gap against you, so if you've got those profits, you want to start protecting them along the way. Okay. Joe is saying, how about if after earnings the price is within the channel? Any trade? No, it's not. That's the key here. So on this trade here, if it was here and you see how it gapped down to this level, okay, then throughout the day it went lower and actually closed outside. But if it had closed somewhere within here, then you disregard it. Okay, you do not want to trade that. The reason why you're waiting for a trade outside the Keltners is because it's a momentum trade, and the bigger that gap, the bigger that move, the more momentum there should be in that direction. Okay, but you'll see here on this earnings play, the most recent one, okay, we gapped from here down to here, but we closed within the Keltners. Okay, so we disregard it and we don't do anything there and we move on. Okay. Timothy is asking, how wide are the Keltners? Well, let me go to the settings here and show you. Here they are. Well, I'll open these up for you. These are the default settings. It's a factor of 1.5. You can set it to 1. You can set it to 2, whatever you like. Basically, this is the 20-period moving average, the length, which is the line in the middle, and it's 1.5, factor of 1.5 on either side. You can play with this. I don't. I leave it as the standard setting. Okay. Let's go through a few more examples. Let me know if you have any other questions on the rules or any other part of this. Let's look at a few more. DuPont is another one that seems to react well with this strategy. And here we go. These are really nice trades like this. Now, you see, we have strong momentum, okay? And earnings are released, and you get that gap. Did we ever get a trade below this line? Eventually we did, but nowhere near the first 2 bars. So really, even though it continued on, this is not something we would be interested in, okay? On the flip side, here's one where it gaps, and we immediately trade above that high. And then off it goes, and we're in it until it closes just below there, or you're scaling out along the way, okay? That's the key. Don't, you know, even though it's a big wide range bar, it doesn't mean it's going to continue there. Even if this was fully red, okay, unless you traded below that low, there's no reason to jump in there, okay? L is asking, on the butterfly strategy, when do you take your trade off? And if it moves to one side, what do you do with the opposite side? Well, usually, L, because you're only paying, you know, $80 or $100 or so, if it moves to the opposite end, on one of them or the other, the one on the opposite side will expire worthless. It's going to be worthless. But again, remember, it's only 80 bucks or so. You're actually hoping that happens because you're in profit on one, which will usually be much more. But there's a couple key things with the butterfly spreads. Thanks for asking the question. Number one, you want to make sure you're not exercised, okay? So If any one of your strikes on that butterfly spread is in the money at that point after that release, you want to take that trade off. You don't want to risk getting exercised. But also when it comes to butterfly spreads, remember, they are a debit spread and a credit spread that overlap at that short strike, the mid strike. If you're trying to close out your trade and your trade isn't getting filled as a butterfly order, a simple and easy way to close out your trade a little quicker is to split it up. Sell the debit spread portion as a debit spread and sell the credit spread portion on its own. Close it out as a credit spread. So you can just separate the two and you'll have a much easier time getting filled and closing out. Jahan is saying, how many days ahead of earnings do you set up the butterflies? Ideally, 3 or 4 days. That same week where the earnings release, that would be ideal, because butterfly spreads don't tend to appreciate until you get closer to that expiration date. So putting them on 3 weeks in advance only means you're going to sit in there for 3 weeks with really no appreciation. But what you're risking is that during those 3 weeks, the price moves away from those target zones. Okay, it moves far away from what you're targeting, and then once that gap happens, it'll close nowhere near those levels. So you only want to do it 2 or 3 days ahead. Okay. Some of these strategies certainly work on other instruments. Armand is asking futures like crude and the NASDAQ, but really these are meant to be put around earnings season. So you typically with stocks that have earnings events, there are times where you can use some of these strategies. Certainly the butterfly strategy you can use in different situations throughout the year on that. And and actually that brings me to a good point. What I've shown you today, you can start using right away. But I've put together an Option Pro training course for you here. And with this Pro training course, it's a 2.5-hour course. And what you're going to get is the on-demand recording that we normally sell for $297. But in this class, I'm going to teach you a number of different option strategies. Number one, credit spreads. I'll show you how to earn a steady weekly income with credit spreads. And here's that powerful butterfly strategy. I'm going to show you when and where you can use it throughout the year, where you're really only risking about $90 for the potential to make $1,000 on each one of those trades. Also, to keep you active in the markets, I'm going to show you a couple of different delta neutral strategies that'll help you make money in any condition, because there's a lot of times during the year where the market's kind of going sideways and you're just sitting on your hands waiting for something to happen. These are great strategies to put on during those times. Also, have you ever gone in a trade and it's gone against you and you'd like to know how to repair it? Well, I've got a couple of different repair strategies for you that I'm going to show you in this class that will help you repair all sorts of trades, whether you're just long a stock and you want to repair it, or whether you're repairing option strategies. Those are really the key that you want to know when you're trading. In addition to all that, we're going to throw in a 30-day membership to our Pro service, and I'll tell you a bit about that. That is going to include all the trade alerts that we have from all our systems. We have several strategies that we use, and in our nightly videos that we send to you every Sunday to Thursday evening, 5 times a week, you'll get a video from me where I'm going to highlight those trades from all those different systems, recap the markets, and also you'll be able to join all our live market chats. They happen twice a week, Monday evenings at 8 p.m. Eastern, 5 p.m. Pacific, or Thursday mornings at 10 a.m. Eastern, 7 a.m. Pacific. You'll be able to come into our room and ask me any trading related question you like on any strategy. We've got that for you for just $47 today. As I said, it sells for $297, but we always like to do something special for our friends at Investor Inspiration here. They always put on great events. I'm going to, I think we have a few more minutes, bring in Raul to our coaching corner, help me answer some questions, but I did want to highlight here the link for this class. Just go to tradingwins.com/crush. This is our Crush the Market with Options class, and that will take you here, and just click on the big green button here at the bottom. Raul, let me just flip over the mic so you can join us. There we go.
It's always a pleasure to join you. Fantastic offers you've put together, especially for these investor inspiration events. It's the course really does sell in our store for $297. Plus, you get the membership. What is it that you like about options? Why do you like trading them so much?
I really like it because once you actually get to know how to trade options the right way, they're actually a lot safer than trading stocks. And in addition to that, we always laugh about it. What we say, you have a lot of options with options. They give you so much flexibility. You can use them in so many different ways. And there are so many different strategies, and I go through several of them in this course. But once you get to know how to use them, they're really very effective, and they can leverage just about any strategy you have.
Carlos was asking, in a butterfly situation, do you ever get into a strategy where you sell part of the butterfly and let the rest of the butterfly run?
You can, yes, absolutely, you can. And again, in the course, we go through much more detail, not only on when to put on a strategy, but what to do with it throughout the life of the trade, and when to take it off, etc. We'll cover all of that in detail.
Kat was asking if you can explain what delta neutral is.
Delta neutral is a position that will make money no matter which way the stock moves, okay? Any direction. So you're covered on both the long and the short side, similar to a straddle, for example. And so you're not trying to guess the direction of the stock, you're just trying to set your trade up in a way that it will make money no matter which way that stock moves. Okay?
A lot of people think they can make all kinds of great money just by playing straddles. Why is that a bad strategy?
Because normally they put them on at the wrong time, and they're not used correctly, just like during earnings season, where they put them on just before earnings, but what they're actually doing is overpaying for the call and overpaying for the put, and then they end up losing money regardless of the move in the underlying. So I'll show you the right way to do that.
A couple of questions about the course. How quickly does it get delivered, and when will my membership be set up? That's
so
Sam.
The course gets delivered as soon as your order is processed. Usually 5 minutes or so, but no more than 30 minutes. You'll have a link to the recording, and it's an on-demand recording. It's yours for life. Watch it as often as you like. And sorry, what was the second half of that question, did you ask?
When will the Pro membership be set up?
Oh, the Pro membership will be set up today. We'll set that up for you today so you can start using that right away.
Mike says, is there a phone number where I can reach you to place my order?
Yes, the number is
1-888-574-2426. We'll put that in the chat box for you as well. We'd love to hear from you if you do want to place your order over the phone. Otherwise, tradingwins.com/crush. Popular question that always comes up, how much of an account, what kind of account size do I need to be able to trade these strategies?
Well, that's the beautiful part, is you don't need a big account. In fact, I'd encourage you to start with a smaller account so that while you're really making sure you learn these properly, you're not risking all that much on your first few trades. As you saw with the butterfly, $80, $90, $100, and you can put on the butterflies. The others, you don't have to start big. Even one contract, one option contract, a couple of $100, and you're off and running. And you catch one of those moves, like on the Keltner strategy, for example, and that'll pay off many more times what you're risking. And that's the key here. What I concentrate on with all my members, you'll hear this over and over again from me in our nightly videos, is we focus on strategies that are going to help you grow your account consistently. We're not looking for one big win and then taking all sorts of risk. I'm actually very conservative, but I'll show you how you can do that.
We've talked with our members at length about how difficult these markets are and how much pain they've had from some of the trades that they've lost. Imagine if they had this course that taught them the right strategies. What could they do with it?
That's right. And unfortunately, many times when I get a new student, they come to me after the fact, after they've already lost a lot of money. I wish they would come to me from the beginning so I can show them how to avoid that. Remember, I wasn't born knowing this stuff. I had to learn it myself, and I went through the same exact experience. I lost a lot of money earlier. I wish someone had pulled me aside and showed me the right way earlier on. But what I'm trying to do here is help you avoid being taught those expensive lessons by the market. So I'll show you the right way.
We always talk a little bit about what's the first thing you're going to do when you have this course and that you can watch tonight. I know the markets are closed tomorrow, yes, but what's the first thing you're going to do on Monday?
You know, that's the best thing is to watch these when the market is closed. You can take your time, no pressure, and absorb the material. But come Monday, and even you don't even have to wait till Monday, but Sunday evening, you'll be looking for actionable trades. And in fact, we'll be back Sunday evening with a video, and hopefully we'll have a couple of actionable trades for you for next week as well that we're putting on.
In terms of repair strategies, tell me a little bit about that in the spirit of the conversation that we just had about trades that have gone bad for people. This is a tough market to trade in.
It is, and you know, again, I get many students coming to me after they're in deep on a stock. They bought that stock, it's gone against them 20, 30, in some cases 50 or more %, and they want to know how to repair it. There are a couple of very easy option strategies that you can use to repair such trades. And also, you know, there's ways where when you're in a trade, and for example, let's say you know, most people like to trade Apple or like to own Apple, thinking that, you know, they've got a great future ahead of them, so you want to hold on to that stock, but you might be worried about an upcoming earnings event that might cause a gap against you or so on. How do you hold on to that stock, okay, for the longer term without getting hurt in the short term? I'll show you a way that you can do that. There's many ways with options.
That leads me into Doug's question, who says, Vince, this has been a tough market. I'm looking for strategies that will help me protect my portfolio.
You know what, and I think you're really going to benefit not only from these option strategies in this course, but in our nightly videos and our live market chats. The strategies we use with our members are very conservative and are very effective in these types of markets. And so once you start watching those videos and join us, you'll understand a safe way of doing this.
All right, Vince, time's almost up. What's the link? How do they get the course?
The link is right up here, tradingwins.com/crush. It's our Crush the Market with Options course. That'll take you to this page. Just click the big green button at the bottom, and it's all yours for a steal, really, $47. Hope you can join us. Thank you again for taking me on, for joining us, and thanks again to Reed and everyone else at Investor Inspiration for having me on. I love doing this. Hopefully we can do it again.